You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
Choice Hotels get you more of what you value. Comfort Inn, it's calling your name. Save on the stay. Oh, and free waffles are yours to claim. Book direct at choicehotels.com.
It's Monday morning. Monday. Oh, gee, how do you like to do affirmations in the morning? Do you do them in the backyard? Do you do them?
Doing sun gods? Yeah, absolutely.
Yeah. You know how I like to do a Monday morning affirmation, Doug? I like to raise my glass.
All right, let's do it.
And I do it, Doug, in a very non-sarcastic way, in a very straightforward, let's just salute our troops
not
kind of way.
passive-aggressive kind of way at all.
Here's to the men and women of our military. On behalf of the men and women at Navy Federal Credit Union, the men and women making podcast in Mom's Basement, here's to a great week of Stacking Benjamin.
Thanks, everybody.
Bottoms up.
It's easy to grin when your ship comes in and you've got the stock market beat. But the man worthwhile is the man who can smile when his shorts are too tight in the seat. Okay, Pookie, do the honors.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and today you'll learn whether you've got what it takes to be a market wizard with best-selling author Jack Schwager. And in our headlines, we're going to talk about a new trend in budgeting. Are you kidding me? There are new trends? Oh my God, I can't wait. Plus, you're probably closer to being a billionaire than you think. Our TikTok Minute will explain just how close you are. Plus, one stacker knew they'd better call Saul, C-High, and OG. And of course, I'll share some hairy trivia. And now a guy with an invisibility cloak covering his hair, and also OG.
Oh my God. You missed one writing meeting, and all of a sudden the writing team turns on you. Hey, everybody. Welcome back to the Stacking Benjamin Show. I'm Joe Saul C-High. Average Joe Money on X, Twitter / whatever. Across the card table from me, the guy, he's got his hair covered up by a cap. It's Mr. OG. How are you, man?
I mean, it's
there.
It's still there.
It's still there.
Doug, is that how much hair you had when you were young and spry like OG?
I think I've got more than that now.
More
False.
I said I think I have more than that now.
In your opinion.
Yes.
If you take all the hair off Doug's back and put it on his head,
exactly.
Ethan has lots of hair.
In the back of my arms. I've got that hair now, too.
How do you manicure that, Doug?
You just don't look at it. You don't manicure it. You just pretend it's not there.
Weed whip.
Weed whacker.
I had a breakfast mentoring meeting yesterday with a young woman who was just amazing. She is graduating from college with a degree in wealth management, and she reached out hoping for some pointers. And listen, if somebody's in Texarkana and wants to go into this beautiful field of personal finance and helping people get their money together, that is incredible. But even more incredible is how she reached out, how she was trying to network. And I was having a discussion that finding the right person and avoiding the wrong person for a role, that's what can make or break an organization. And we just don't see that many qualified people. So how do you find them? Well, Indeed sponsored jobs is a boost whenever you need to find quality talent. If you're hiring, Indeed is all you need. You can stop struggling to get your job post even seen on other sites. You'll match with quality candidates with Indeed's sponsored jobs. Get matched with and hire quality candidates who can drive the results you need. Reach candidates who meet your specific criteria like skills, certifications, or location. It drives me crazy when I'm matched with all kinds of people who aren't a fit. I don't have that kind of time. People are finding quality hires on Indeed right now. In the minute I've been talking to you, companies like yours made 27 hires on Indeed, according to Indeed data worldwide. Sponsored jobs posted directly on Indeed are 95% more likely to report a hire than non-sponsored jobs. Spend less time searching and more time actually interviewing candidates who check all the boxes. Less stress, less time, more results. When you need the right person to cut through the chaos, this is a job for Indeed sponsored job. And here's what's cool, Stackers. You're going to get $75 in sponsored job credit to help get your job the premium status it deserves at Indeed.com/podcast. Just go to Indeed.com/podcast right now and support Stacking Benjamins by saying you heard about Indeed right here at Stacking Benjamins. Indeed.com/podcast. Terms and conditions apply. Hiring, do it the right way with Indeed.
Well, wait a minute. So how often do you have to change the little thing on your weed whacker? Because that's some dense growth there.
Right. Yeah. It's, maybe bi-weekly.
Tell me about that process.
Well, first you need a Torx number 22.
In business, there is no room for guesswork. Every shipment matters. Every deadline counts. And when you're trying to keep operations running smoothly, the last thing you need is uncertainty. That's why reliability is at the core of USPS Ground Advantage. From the moment your package is first scanned in, it moves through a secure nationwide network, aiding in a timely and accurate delivery. You get near real-time tracking so you can keep up with your shipments. And with affordable upfront pricing, there are no hidden fees or surprise surcharges to throw off your cost sheets. It all adds up to predictable deliveries you can depend on, because knowing your logistics are handled lets you focus on everything else, your customers, your team, and the future you're building. Visit USPS.com/Ground Advantage to start shipping with confidence. USPS Ground Advantage. We mean business.
Oh, manscaping's never been better. Never
You
been
can use
better.
power tools for your personal grooming, man. You have reached the pinnacle.
Jack Schwager here, one of our absolute favorite mentors. If you're somebody that would like to be more of a stock market wizard, Jack Schwager studies people that do the unthinkable. They actually beat the S&P 500. But before that, we've got a beautiful headline.
I thought you couldn't do that.
Got a beautiful headline, OG,
Turns
about
out
budgets. So we're almost as excited as Doug. So let's go.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamins headlines.
Our headline today comes to us from CNBC. Jessica Dickler wrote this piece. For 2024, the quiet luxury trend is out and loud budgeting, they call it, is in. Here's how to make the most of it. Are we tired of the pet names?
No, I like them.
Loud budgeting. You do like the name loud budgeting?
Yeah, because I'm loud and obnoxious, so this fits right in with me. Why'd you think I was so excited about it in the open? I suggested this headline. I'm like, yes, finally budgeting for me.
I get to walk into a restaurant and go, I'm cheap as hell, and you're not getting a tip.
Live from Doug's Budget. I'm not paying a damn thing.
Jessica writes, just months ago, we were coveting Loro Piana cashmere baseball hats and
Still are.
$300 Smithson notebooks in the name of, quote, quiet luxury, and justifying each expensive purchase as using, quote, girl math. But in 2024, I didn't hear you say still are. Not using the girl math, OG. But in 2024, there's a new idea taking hold that overtly rejects the urge to overspend and promotes speaking up about saving money. Welcome to the era of loud budgeting. That's what they're calling it on TikTok, all the kids these days. It encourages consumers to take control of their finances and be vocal about making money-conscious decisions rather than modeling purchase decisions after celebrities and their bottomless pockets, and financial experts love it. OG, you're a financial expert. Do you love it?
I wasn't listening. What am I loving?
He was out as soon as we said quiet.
He's such a big expert. I don't need to listen to that. I got it handled. You know, what's funny about this, I've always thought that just because LeBron James buys something, or just because Eva Longoria buys something, or name a celebrity.
Those are some like pretty disparate names. Like how did
like why do
LeBron and even Longoria.
Why do I have to buy it? Because they have it. I mean, the idea that because an influencer owns it, then clearly it belongs in my driveway.
I saw this funny, I don't know if it was a Instagram or I don't go on Instagram, a YouTube video or something like that. And I think it was one of the late night talk show hosts. Might have been like James Corden, or is it James?
Yeah. Yes.
Yeah.
I think we call him Jimmy.
Because the rest of them are.
Might have been him or one of those other guys. But anyways, they were at lunch with LeBron and he's got the bill and he's like, all right, so you had the salmon salad with the capers. And I told you those soda refills weren't free. All right, it'll be give me $32. And he's like, no, you're LeBron James, man. And he's like, yeah, what's that got to do with anything? He goes, I'm not paying for lunch. You're LeBron. You're paying for lunch. And he's like, no, man, I didn't order the cheesecake. That's not me. And like, it was just this big funny skit. So finally he's like, all right, fine, I'll pay for it. Like, how much do I owe you? And LeBron goes, oh, shoot. Can you
searching for his wallet?
Yeah. After the guy pulls it out, which is kind of funny.
LeBron and your brother have a lot in common.
Yeah, they do. Yeah, steak brother.
I have a great story from my brother. I wasn't there directly for this, but they were playing poker at a guy's house during the dot-com boom. He had just sold his company for like $120 million. And they're over at his giant house. This is outside of Boston. And they're at his giant house playing poker. Boston. And they're getting pretty deep into the night. And they all have to ante up. And all of a sudden, the guy who's the host, who's just, bajillionaire, and he was before he sold his company, and now he is even more. All of a sudden, he goes, oh, shoot. And right away, my brother reaches into his pocket and goes, you need a couple of bucks, man, to ante up? I can help you out here. They're sitting in like this 10,000 square foot mansion.
He's fresh. He's plumb out.
Yeah. My brother throws a 5 on the table. I got you.
But still, what's funny is, you look at Dr. Thomas Stanley, who famously wrote The Millionaire Next Door, but he also wrote a couple other books about networking with millionaires and also about selling to millionaires. And what I found interesting in the selling book was that people, when they're around millionaires, expect the millionaire to pay. They expect the millionaire to be all lavish. And Dr. Stanley made this great point. He goes, that's not how they got there. They got there because they minded their money. And I think it is cool when you see people that have money go, yeah, I'm not paying for that. Like, I'm not doing that. That type of outlaw budgeting, I think, is pretty cool. It sets a nice example, OG.
I think that there's just a lot of opportunities in your regular day-to-day life where it can make a big difference. And you don't think that it adds up over time, but think about like a car purchase, for example. The new car smell, how great that experience is to go in and get the thing that you want or order or do whatever. And, maybe you do that how many times in your lifetime? 5, 6, maybe. Instead, if you bought the year-old version, which is still got all the same tech in it, which
now has a new to me smell,
still virtually, brand new. It's just got the depreciation kicked out of it by some other gal or guy, and whatever. And it's like that $10,000, $12,000, $15,000 change, plus the interest on the loan that you didn't take for that money 5 or 6 times over your lifetime, turns into a bunch of money just by making one little tweak that the only person who knows that's not a brand new car is you.
Yeah. And I think one of the points of this piece is it's now getting trendy to be overt about, hey, that doesn't fit for me and what I'm doing right now. Whereas usually the stigma is you don't want to look like I'm the person who can't afford to be here or is choosing not to buy this meal or something like that. This is really taking our Midwest values and making it national. How many times do we say, hey, Joe, nice sweater? And you're like, oh, you like this? I got it at Target. It was only $8. Like that. That's a Midwestern thing. We all do that when somebody compliments you. We talk about how inexpensively we got something. I feel like this is just magnifying that out on the front end of that discussion to say, yeah, guys, I don't want to go to that restaurant because it doesn't fit with my month right now, my budget right now.
I love that flex, Doug, how you just called us trendsetters. Are you saying we're trendsetters?
Sure.
Neither of your guys' sweatshirts are trend sweaters at all. Just
You don't think that my Molson t-shirt over my Mr. Rogers sweater under
It's
my
a cardigan zip up. So let's not flex quite yet, fellas.
There aren't even suede elbow patches on that thing, Joe.
I know.
But I do like, Doug, what you're saying, because I saw yet another video of a frustrated person who went out to lunch with a bunch of friends that were more wealthy than she was. And she ended up, everybody at the table goes, oh, let's divide it evenly. And she specifically didn't want to go to the restaurant, only went because it was her best friend's birthday, and ended up with 1/5 of this bill, where she specifically got a salad and water because she didn't have the cash, and then was made to feel guilty and judged. And so for her, this is a great trend.
Yeah. To be able to say, nope, can't go. Sorry.
Yeah.
You do you.
I do think no matter whether we're a millionaire now or somebody working on it, being out loud, we had Gigi Gonzalez on talking about that being a mentor in her family. I think it's super important. We will dive more into this in our newsletter, the 201, stackingbenjamins.com/201, and ways that maybe you can have some of these conversations that at first seem awkward, but hopefully they are becoming trendy and more like us, frankly. stackingbenjamins.com/201 for that. Hey guys, time for the TikTok Minute. It's part of the show where we shine a light on a TikTok creator who's either creating brilliance or creating some air quotes brilliance. Doug, I went to you last time. Let's go back to OG. OG, we're going to see some brilliance or air quotes brilliance out of our TikTokers today.
Yeah, the new year, new me is over. So this is going to be trash, as the kids say.
Just like our New Year's resolutions.
Yeah.
OG's over it.
I'm over it.
He's still bitter about failing at dry January on the 3rd.
I'm trying
those
dry
first 2 days.
February 4th. One step at a time, Doug.
Dry day.
Don't shame me.
Crystal,
I'm trying.
Crystal on our sister show, is it sister show? What is that, right?
Yeah, we'll call that sister show.
Okay.
Sure.
She has damp February, I think she's doing.
Right.
I like that.
I like rainforest February. Myself.
That's what you go.
I go
Hurricane Katrina February.
Hydration February.
Hanging out with you guys. Here's the cool thing. Part of getting up in the morning, though, is getting motivated. You got to stay motivated. We talked about New Year's resolutions, staying on top of it. And, you look at these people who might be way ahead of you in terms of their net worth. Well, these DJs in Australia have talked about how close you are to being uber wealthy. Let's listen in.
Just want to remind everyone, if you have a net worth of $100, you are 32 blackjack hands away from Elon Musk. Give mate, keep punting.
It's a very interesting way to look at it.
I wonder what the odds are of winning 32 hands of blackjack in a row.
Slim to none would be my guess.
Yeah.
Oh, come on. But, you're only 32 blackjack hands away. I mean, we could listen to Jack Schwager today talk about the stock market, or just win 32 hands of blackjack in a row, and you're Elon Musk.
So close. I'm going to give it a whirl. I think this weekend I'm going to hit up the casino. Just see what happens.
If anybody can do it.
This slow but steady thing is for losers, right? OG gets the win on that one. I think that might be trash. Coming up next, I absolutely love this guy's work. Back in 1989, he released a book that went way bigger than his publisher thought, than anybody thought. And it is case studies of people that he called market wizards, these people that have beaten the stock market. And he just went, it's case study after case study of how these people did what they do. And there are tons of lessons in not only market wizards, but in his next book, The New Market Wizards, Stock Market Wizards, Hedge Fund Market Wizards, The Little Book of Market Wizards, and now the second printing, expanded edition of The Unknown Market Wizards, people we've never heard of that are quietly beating the heck out of the market. We're going to learn from Jack here in a minute, maybe shine a light on some fantastic investors. But first, Doug, you're going to talk a little bit about wizards, I believe.
Absolutely, I am. Hey there, stackers. I'm Joe's mom's neighbor, Doug. As I'm sure you've already assumed, I'm a pretty avid reader. I mean, look, I read all day, every day. Signs, captions, emails, you name it. I've even gotten into big books lately. I'm talking like more than 100 pages.
Wow.
You know, it's unlike me to brag. I don't do it that often, but I've even been breezing through Harry Potter. Joe's mom's been teasing me saying, those books are for children, which is not true at all, Ma. First of all, I know parents that read them to their kids, which means they're too advanced for kids to read on their own. They got to have adults do it. Second, there's pretty big words in there like hippogriff and quidididich and a pirate and expelliarmininus. I mean, like, I'm practically learning a whole new language over here. Considering how popular the series is, I should start doing magic as a side gig. You know, like strike while the iron is still moderately hot. All you got to do is hide cards up your sleeves and guess which one someone picked. I'd probably make millions at company parties and weddings and funerals. Hey, watch this body disappear into the ground. I bet I'd be a huge hit at weddings too.
Too soon?
No, but seriously, the wedding gigs. Ladies love magicians, right? At least more than clowns. I used to think they loved clowns at weddings, but boy, was I wrong on that one that time. Hey, today's trivia question for all of you budding investment wizards is, if you don't have magical powers, what would the wizards in Harry Potter books call you? I'll be back right after I practice guessing which card I'm holding up.
Insurance isn't one size fits all. That's why drivers have enjoyed Progressive's Name Your Price tool for years now. With the Name Your Price tool, you tell them what you want to pay, and they'll show you options that fit your budget. So whether you're picking out your first policy or just looking for something that works better for you and your family, they make it easy to see your options. Visit Progressive.com. Find a rate that works for you with the Name Your Price tool. Progressive Casualty Insurance Company and Affiliates. Price and coverage match limited by state law.
What would you do if your online store converted 36% more shoppers? You could take 36% more vacation.
Another pina colada?
Yes, please.
Open a new retail location with 36% more square feet.
Fantastic.
Hire 36% more help.
You're hired and you're hired.
Shopify has the world's best converting checkout, up to 36% better than other e-commerce platforms. What you do with those extra sales is up to you. Switch to Shopify today at shopify.com/listen and get a $1 trial. Shopify.com/listen.
Hey there, stackers. I'm speed reader and close-up magician, Joe's mom's neighbor, Doug. During the break, I bought myself a magic kit. I don't think I want to jump the gun on this, but I think I may have found my calling. I've only practiced in front of the mirror so far, but I've even surprised myself. I mean, I seriously had no idea what hand the ball was in. I mean, that's scary good. Today's trivia question is, if you don't have magical powers, what would the wizards in Harry Potter books call you? The answer? If you're a mere commoner like Joe or OG, wizards like myself and my good friend J.K. Rowling would both refer to you as a muggle, which is interesting because I thought if I learned magic, they'd stop calling me a cracker. Gotta look up what that means, I guess. And now, here to teach you about what you need to know before you think about becoming a stock market wizard, it's today's mentor, Jack Schwager.
Well, when it comes to the hundreds of smart people who've influenced my investing behavior more than anyone when it comes to investing, I put this guy easily in the top 5, maybe in the top 1 or 2. Jack Schwager's back. How are you, man?
I'm doing great, thanks.
I'm so happy you're back with us. It's got to be gratifying, Jack, to see not just me, but even just all the people I talk to about your books to see how much this work, not just the reprint of Unknown Market Wizard, but just Market Wizards in general, that's resonated with so many people.
Yeah, I get that feedback too, thankfully.
How did this begin? For people that missed your first time here, how did the whole Market Wizards series begin?
Yeah, well, I knew some great traders back in those days. I was a research director for Wall Street firms, and I had the idea. I knew some great traders, and I had the idea of doing this book, Market Wizards. But being a research director is a full-time job. You don't really have time to do it. Yeah. I had taken a sabbatical to do an analytical book, like nearly an 800-page book, and that was good for what it was, and it sold okay for what it was. But the next book I want to do is a more popular book, which ended up being Market Wizards. But I didn't have the time, and anyway, the catalyst was another publisher was familiar with the analytical book, wanted me to do a whole bunch of analytical books for them. I said, no, thanks. I've done it, been there. I don't want to do that again. Although I did end up doing it again, but that's another story. I said, well, if I was doing anything else, I'd do this book, but so he said, okay, why don't you do that? I said, okay, I'll do it, and I just needed a push. I needed a push.
Was Market Wizards a success right away?
Yeah, it was. Right when it came out, there was a Wall Street article that came out, a review article, and, favorably on the book. And the book sold out. Immediately sold out. The publisher, who shall remain nameless, was just horrible. It took them like about a month to get restocked.
Oh, no.
So, yeah. I mean, it was just, total incompetence. And, so, but the book was it was an immediate success. And, yeah.
I find myself devouring these because I think strong traders have strong personalities. You're able to bring out their strong personalities and really just the themes, the things we can learn. I'd love to dive into just a couple of the people early in this book, and maybe we'll make this a case study and then people can pick it up and get more. But let's start off where you begin with a guy named Peter Brandt. These are market wizards that most people have never heard of, as you know, Jack. That's why it's called Unknown Market Wizards. But tell us a little bit about Peter. Who's Peter Brandt?
Okay, so Peter's a real veteran trader with the quotes around veteran there. He started trading back about 40 plus years ago. I went through two phases. He traded for about 20 years, then decided he didn't want to trade anymore. Went completely cold turkey to trading, didn't look at markets, didn't do anything. And about 12 years later, he decided, maybe I should try trading again, And he hadn't been following markets, hadn't been doing anything. But he got started and he got caught up in it again. That was, I guess, I don't know, maybe 15 plus years, maybe 15 to 20 years ago. So he had these two approximate 20-year careers in trading separated by this period where he didn't trade at all. And, in both periods, he did extremely well. I mean, he averaged roughly, I guess, around 40% or so. I may be off by 10% one way or the other.
Yeah, but still amazing.
Yeah, and he's big. He's really big on risk control. So for him, I mean, taking a 1% risk on a trade would be enormous. He doesn't do that. So all his trades are like fractions of a 1% risk. And he tries to get into break-even risk as quickly as he can. He's also a classical chart trader. Going back to before Edwards and McGee, there was a book, which I know only through Peter, by Schwager, which preceded Edwards and McGee, which is the book most people think started technical analysis. So he goes all the way back in his research on chart analysis to that time.
I think you say talking about that book. Is it like 1932? Like in the 30s?
Yeah, 1930s, right.
Well, and this is the first thing. Let's dive into Peter for a little bit that I found, kind of parsing the discussion that you had with Peter, your discussion with him. All I hear about every year when I was a financial planner, the last 15 years of doing financial media, Jack, all I hear is about the new thing, right? There's always a new thing. And Peter goes completely the opposite. Peter's using stuff that is so antiquated that nobody follows it anymore but him. Is this a trend that some of the traders or a lot of the traders stick to some of these old methods that other people have forgotten and, because they're so looking at the hot stuff that's happening today?
No, I mean, this is one of the points I make in all my books is that people gravitate to a style that fits their personality. And he's just comfortable with that old style. Very at the beginning of his career, when he used to, he worked for he worked as a broker, and his clients were these large food companies in futures, sort of hedging their product. And, he was not successful in the first few years, or he didn't trade it lightly, whatever. But he found success by finally going to technical analysis, chart analysis. And that's just what worked for him, and it stayed with him. Now, he'll be the first one to say that it doesn't work a lot of the time, and there's no magic to chart analysis. It doesn't predict anything. But what he says it does for him is it identifies those points in time where he can set up a trade that has a good win-to-loss ratio, that he has a good shot of making much more in the trade than he has to risk. It's a meaningful, something that develops on the chart that he said, okay, this is a meaningful point. The market should go, let's say, up right here. And if it goes back down, where it was 2 days ago, something's wrong and I'm out. So he identifies those points. It's not that charts are predictive so much as they allow him to pick points where you can put on these trades. And he always does it with very minimal risk.
It's almost like as an artist, it's the canvas he paints on. Like he's not going to change canvases.
No, I mean, this is what works for him. Now, he does change. There used to be a lot of patterns that he used to use, which no longer work anymore. And so he doesn't use them anymore. So he has changed in the way he applies that method. Certain patterns now more important, much more important than they were. Certain patterns that used to be important, he no longer follows. So he does have to adapt to the way the markets change, but he's using the same basic methodology.
I love this working on the machinery kind of approach versus going from diet to diet to diet, if you know what I'm talking about. He's just tweaking the machine. You write that, you talk about that this is what really works for him. You write that there was one period where people told him, no, this is the new thing. And he started losing his ass, Jack.
Well, the thing was that he had at that particular point, here's the critical thing. Maybe he wasn't meant to manage other people's money. But he for years, friends were asking him to manage their money. And finally, one year he gave in. He started managing money. And as soon as he started managing money, he hit a losing streak. And it was during the losing streak, he started trying all these other new so-called newer technical approaches and whatever. And, none of it worked. And he just got deeper and deeper in the hole. And finally, after about, I think it was a year and a half, close to a year and a half, I think, where he was in this drawdown period, he just said, that's it. He gave all the money back to the people who invested, just went back to trading his own account. That was his exact low. The next 17 and 18 months, he was straight up. And of course, he went back to his old approach. So it was a combination of both realizing that he was uncomfortable managing other people's money, and secondly, that he had deviated from what had worked for him all these years and just going back to who he was and what he was really comfortable with.
I feel like for several of the wizards that you have interviewed, that they really feel uncomfortable with maybe not just other people's money and taking them along for this ride, but also the huge asset base. And I think about how we often hear that you can't beat the stock market. And yet, because these huge money managers are dealing with so much money, of course, Jack, they got to get in slowly. They got to get out slowly. It is the mechanisms by which they have to trade make it nearly impossible for them to beat their benchmark because they're trying to mirror it so much. Do you think the fact that they're dealing with so much less money, not small sums, but so much less money, that helps them be nimble enough that they get their big shot at it to beat their index?
Yeah, I certainly think it's an advantage, or maybe the absence of a disadvantage when you're a small trader, because you don't move the market by what you're doing. Although some people are paranoid enough to think that they do. Boy, the market went for my stop. They might be trading, one or two futures lots, and they think, believe me, the market's not going after the one lot, position. It's just your stop is where everybody else's stop is, and that's why you got stopped out. But it's definitely an advantage if you're small enough to get in and out and doesn't cause any ripples. Surely, in some of these other books where I interviewed hedge fund traders trading huge amounts, billions, that's much harder. That is much harder. Traders like somebody like Bruce Kovner or Paul Tudor Jones, some of these really extremely famous traders of recent time, of my lifetime at least, when they transition to managing these larger firms and managing billions or tens of billions of dollars, they still did okay, but their returns were nothing like the returns when, at the point I interviewed them, when they were trading mostly their own money.
Yeah. It's almost like the Morningstar manager back in the old days when he'd hit 5 stars and then he's screwed because he gets so much money thrown his way.
Well, that's another thing. That's a regression to the mean.
Right.
So that's but a lot of these so-called 5-star performances is not because the manager is great. It's because they're trading the right strategy or the right market. So you get a year where energy does great. Who's going to be all the 5 stars are going to be energy managers. Doesn't mean that they're brilliant. It's just they happen to be trading the right strategy at the right time. And in that book, Market Sense and Nonsense, I actually did studies in that book. For example, I took looking at the best strategies and the worst strategies, and what happens in the following year. And sure enough, the worst strategies, I think, ended up doing better than the best strategies.
Wow.
Yeah,
Wow.
yeah, because you get that reversion to the mean. Because what is it? If something is done best, what does it mean? It means that market or that strategy is going on, and I did it over 1, 3, and 5 year periods, has done really well over that past few year period.
Sure.
So it tends to get exhausted. It's like it's capturing the period where crude oil goes from $30 to $100. So sure, and when that happens, you get more supply coming out, you get demand constrained, and things, it sows the seeds of its own destruction. And so that's why you get this pattern where best performing funds often become worst performing funds and vice versa.
In a couple of the early character studies in this book, we talk about Peter Brandt, then you go into Jason Shapiro. One thing that those two have in common, Jack, is that they both, to your point, right after their best year, they say then they had their worst year. Is that reversion to the mean? Is that getting too cocky? Is that believing your own BS to some degree? Like, what do you think creates this dichotomy between greatness and then horrible returns?
That's some degree maybe reversion to the mean, but there's something else that goes on. This is when we're talking individual traders where they're making these discretionary decisions, which is true for Brandt and Shapiro, and actually almost all the book traders in the most recent book. When you're doing that, if you have a tremendously super successful period, you tend to get more complacent. I mean, it's just human nature. You sort of, you tend to relax. Oh, I got this. And, you're getting a little sloppier. Yep. And it's that aspect of it. It's that, people sort of, when they're coming out of a bad period or just normally, these traders tend to be very, very focused and disciplined. And it's not that they have this fault, but I think human nature, if you go through this really super successful period, there's a tendency to get less intense and less restrictive.
During those times when things are down, both of these two gentlemen are trading in the futures markets, which most of our stackers are in index funds, Jack. So they wouldn't imagine being in these super risky markets. And yet both of them talked extensively to you, not just Peter, who really part of his backbone is risk management, but they both talked to you extensively about getting beat up and then learning about risk management. Talk about managing risk and stop losses in volatile markets. Is that something that the average person should be doing?
Yeah, well, here I got to make a distinction for your audience. You have to know whether you're an investor or a trader, okay? And also whether you're somebody who's just investing without any belief that they are special or have any particular skill. They just want to invest money for the future and do it in a reasonable way, versus people who are actual traders and think they've got a method that can do better than the market. So those are two different universes. Now, for the audience who's just investing reasonably for their money and don't have any particular skill, actually the best thing they can do long term is buy index funds and forget about low-cost index funds and forget about it. It's a different world. For traders, however, their risk management. So the idea of risk management in the first instance is kind of almost impossible, because then you'd end up sort of getting out of markets when they pull back. Let's say an index fund when it pulls back, which is not a good strategy, because that's, a lot of people do that. They sort of get scared and they get out. And that's the wrong time to get out. That's when you should be investing. So it's a different world. But for traders, they're trying to make money sort of in a consistent way without losing much. And they can't just sit and hold. If they sit and hold, they can get wiped out. So their risk management is critical. It's more critical, as almost every trader I ever interviewed, it's more critical than the actual methodology. Every professional trader who's successful every trader will tell you that risk management is the key and everything else is secondary.
Both of these guys, Jason and Peter, both got wiped out, you write, several times before they finally found success too. How often has this theme of resilience been a piece of being a wizard?
Well, it's common. I think into the first chapter of the first Market Wizards book, with a fellow by the name of Michael Marcus, is a whole litany of wipeouts, complete wipeouts. And you say, God, how did this guy keep on going? Why didn't he give up, 3 different times? So it is common. I mean, it happens. There are people in every book that I've done where that is true. So even the best traders may have had trouble in the beginning, and not so much with Peter. Peter lost a little bit of money. He didn't have that experience, but Shapiro certainly did. Shapiro, he did well. He got up to nearly $1 million, blew it. I think luckily he bought a sports car, which was lucky because that was the only thing that was left at the end, because he couldn't lose that. Then he went on and he lost it again, and finally he sort of got it, and it became a matter of risk control. And he uses his early years as a model of what not to do. So he finds people who look like him in his early years, and he will fade them. He said when they get bullish or they get bearish, he wants to do the opposite because he sees they're subject to the same emotional stuff that he was falling for when he was a preliminary, an early trader.
I love how Shapiro learns from his own experience, to your point. I love when he went to Africa. He goes to Africa and he leaves his account alone. That's been a disaster. And he kind of feels happy. I get the feeling he feels happy to leave it alone. It's a dumpster fire. He comes back, he's made a bunch of money, and he realizes that sometimes it's what you don't do. Like investing often, Jack, is one of the few pursuits where by not doing something, you can win.
Well, it's sort of like a hidden example of patience. So one of the many traits I point out in books is that's important to be successful is patience. And an important part of patience is staying with a position that's a good position. Because most people get tempted constantly to get it. Oh, I got a profit. I'll take it. And it becomes very difficult to stay with a position, even if there's a reason why it should continue working for a longer term. So by going to Africa, not being able to look at his account, he sort of forced patience on himself. And of course, he just ended up staying with those positions. Yeah, I think he had stops in, so it wasn't reckless. I mean, if the market went down against him, he'd have been out. But in the meantime, as long as it was going, he wasn't tempted to be getting out because he didn't see the market. And so that was his best performance, and it provided a lesson for him.
I love it. I love how each of these dispel a lot of myths. We think we got to be perfect all the time. We don't. We learn. We work on the machinery. We don't mess with get in this die, get in this thing. We tweak the machine. We tweak the machine. We tweak the machine. Another lesson that I like is a lot of our stackers, I think, Jack, think, well, I didn't go to college for this. These guys probably went to college for this. Peter Brandt was in advertising, you write. Right. Jason Shapiro was one of the crappiest students, I think, of any of the market wizards you talked about.
You wouldn't argue with that.
Does education, were there many market wizards where their educational experience mattered more than their on-the-job learning and development?
Well, some. I mean, in some cases, the pure intellect was the method. Somebody like Ed Thorpe, who's working on his PhD for physics, decides he doesn't know enough math, goes and takes courses in math and writes a PhD for the math and gets his math PhD, never bothers to write his physics PhD. But brilliant guy, teaches himself. This is back, he kind of went, he's one of the old, he goes back a long time, but when he was in high school, it was Depression time, and he was in a poor area, lousy schools, sort of taught himself physics in high school, got into one of the top colleges and went from there. So he's just a brilliant guy from beginning to start. He came up with all these methods to beat the markets that were kind of really mathematical. In fact, the famous Black-Scholes model on how to price options.
Oh, yeah.
He kind of figured it out. He came up with an equivalent formula years before that paper was published. So for years, he's trading options. He's probably the only guy in the world who knows how to price options. So in his case, is that the education, the creativity of what to do with that education is a big deal too, obviously. But he couldn't have done what he did without being brilliant and, brilliant quant. So you get that side too. And you get people who are just, as you said, lousy students, maybe dropped out of college and all of that and still do well. Education is not a common denominator in success in trading.
Yeah, not a predictor. Just reading these people. Jason has well, you know what? While you're telling us about people, I've mentioned Jason Shapiro a few times. Our stackers are wondering, who the heck is this guy? Tell us who Jason Shapiro is.
So Jason basically is as we talked about, he went through his early failures and he became a trader. Trading became his career essentially, but his trading methodology is he's a contrarian. He always wants to go opposite to where the major crowd is. Now, the tricky thing in that is the crowd can keep on going for quite a while. So he marries that approach with watching for the market to behave in a way where it shouldn't. So let's say the statistics he's using, which are these CFTC commitment of traders reports, which show how large the commercial positions are, which are companies that are using the markets for hedging, more professional, and the speculative positions. And he's looking for the speculative positions to get, let's say, very bullish, and then he wants to get bearish. But he waits then for the markets to have a situation where some bullish news comes out and the market goes up and it comes down and closes weak. That's a type of situation where he'll then go short. But his approach is strictly contrarian. He watches things like CNBC to do the opposite. That's his trading style.
But for the average stacker listening, it seems to me, Jack, this one is incredibly dangerous, because I think swimming against the current for a long time is going to lead to going against momentum is a difficult place to be.
Oh, well, the key is, I said, there's two things that make his strategy work, at least for him.
Yeah.
One is the timing. He doesn't just blindly he'll let the markets go, but he waits for the market behavior to tell him, okay, now is the time. And the second thing is he always accompanies his trade with a stop. So if the market, let's say he's saying, okay, the market is top, he'll have a stop somewhere above that high. So if it goes to a new high, okay, he's wrong, he's out. Otherwise, this type of strategy, as you say, could be an easy way to get wiped out. You have to have a protective risk methodology.
I love all the lessons we get from this, the lesson of patience, the lesson of having an investment policy statement. All of these people, frankly, even though they're trading and a lot of our stackers, Jack, are investing, still having an investment policy statement that you're working from and a machine you're working from versus whatever my tuna fish sandwich at lunch told me was a good idea, right? Is probably a better way. My favorite quote from you, though, the last time you were here was, I asked you if markets truly weren't efficient. And your quote, I think, to me was, markets are not efficient, but for the average person out there listening to this, they should probably pretend they are. You're nodding your head. You still agree with that?
Yeah. Yeah. In fact, I think near the conclusion of the Unknown Market Wizards, there's that, I use a little kind of joke parable to make the point. The conclusion there is, and this comes after all the interview chapters, the conclusion basically is that the markets are not efficient. They're so difficult to beat. And in many ways, they do act like they're efficient, that for most people, unless they have some special skill, they're better, like you said, they're better off acting as if they are efficient, which means just invest in an index fund and don't try to beat it yourself.
And you know what? There's still so much to learn by studying these people. Even if you're an investor, not a trader, I've learned a ton, as I mentioned earlier. The book is Unknown Market Wizards. It's updated. There's so much new stuff from when I read this. It feels like yesterday. I can't believe this book is as old as it has. It's timeless, Jack.
Only 3 years. The original book came out 3 years, and there's about 25% new material in it.
Maybe it's because it was pre-pandemic.
Yeah, it came out right before, which is one of the reasons I added the material, because we had the pandemic. You had the bear market that caused, and you had the bull market right after that. And then you had another bear market. You had some big bear and bull markets in the last 3 years, and I just wanted to see how these traders fared.
Isn't it wild how much has changed? And I love these after 3-year interviews. 3 years later, what are you thinking? And I love how some of them have changed, but once again, Jack, what you saw was they're changing the machinery 3 years later. They're not like their thesis isn't dead. They're just tweaking.
Yeah. Nobody changed their methodology. They're still doing the same thing.
Yeah. Book is available everywhere. Unknown Market Wizards. We'll link to all Jack's work on our show notes at stackingbenjamins.com. Jack, thank you for mentoring us again on being better investors. I appreciate it.
Glad to be here. Enjoyed it. Thank you.
This is Rebecca from Connecticut. Instead of stacking Hamiltons and Jacksons, I'd much rather be stacking Benjamins.
Huge thanks again to Jack Schwager for joining us. And at OG, lots of great takeaways. You stay in the market, you stick with your plan, you don't blow up your plan. But my favorite of all is don't try to beat these people. The market is not efficient, but we should pretend it is because you don't want to go through what these people went through.
Well, I mean, I think that the market is efficient, especially for all the market participants as a whole. There's going to be some outliers that are able to succeed otherwise, but repeating that over and over again is the hardest part. That's just, I mean, it's no different than getting a 6-way parlay on DraftKings on Super Bowl weekend.
I don't know, man.
You might do it, but you ain't going to do it every Super Bowl.
The fact that these people do it over and over and over shows me they're playing in these little nooks where it's not efficient, but getting to that spot.
Yeah.
And the number of times, look at the number of times.
Owning it.
Yeah. And the number of times he said these people blew up their portfolio before they found it. Like what? The one guy blew it up 4 times.
Yeah.
Imagine making some money and then going back to zero, then making some money and going back to zero, going back to, like, by the 3rd time, you're like, are you kidding me? And then finally he quote, finds it.
Not repeatable by somebody who has a normal job.
Go work your day job, but still staying with your plan. I mean, how many times have you seen people with maybe the marginally wrong plan win because they stuck with it versus people that are hopping from good plan to good plan to good plan to good plan, always searching for the next thing, and they never go anywhere.
I mean, a great example of this is should I put money in my pre-tax 401k, my Roth? It's like, that's a fringe decision that we don't know the answer to, except in 20 years from now, what tax rates are going to be. But I can tell you should probably max it out.
So the answer is
yes.
If
you're going to wait for the exact perfect tax strategy, you're going to miss out on the fact that you should have put 23 grand in this year and your company would have matched that. And I was reading some stuff about Charlie Munger, different quotes and stuff like that. And he was talking about how, the first 100,000 is the hardest. And that kind of led to something else that I mentioned a couple of weeks ago, that if you save, $1,000 a month, by the time you get to 300,000, you're halfway to $1 million because of the fact that money's going to compound. And it seems like it's going to take this super, super, super long time to grow your wealth, but you can only see the progress if you look backwards. You can't see progress if you're doing that calculation in the future. And so the best way to do this is to do it and then measure backward and say, all right, 5 years ago I had this and now I have this. 10 years ago I had this and now I have this. If you're looking into the future going, oh my gosh, this is going to take 10 years to grow, that's the wrong approach. Set it up, invest it, don't touch it for a long time, and you will be wildly rewarded.
There it is. Magic. Thanks again to Jack, and we will dive more into that, all of that, how to have an investment policy statement that wins, how to maybe find a little bit better strategy so that you can go further. stackingbenjamins.com/201. Time for one stacker who'd better call Saul, C-High, and OG. I'm not sure that I like Steve's banjos that he plays over. It's like, at first
I don't think that's the vibe that we're going for.
No. It sounds a little deliverance-y, doesn't it? Like, I don't think I'm calling that segment. I know where that goes. Oh,
if we ever tell some caller to squeal like a pig, it's over, man.
StackingBenjamins.com/voicemail. And maybe give us an idea of maybe some new theme music. But today, Carrie said that she had better call Saul, C-High, and OG. Hey, Carrie.
Hey, Joe and OG. You too, Doug. Hey, it's Carrie from the Chicago area. I recently was hanging out in the basement and came across a related topic, so I thought I'd ask you for your thoughts. The question was pertaining to withdrawal rates in retirement. And while I'm not at retirement age yet, it really sounds like a great idea on a whole lot of days. I'm 49 and my husband's 54, and when I look at the numbers that we have awaiting us in our Social Security projections, it seems like a lot of money. I was always taught to not count that as part of your retirement numbers, but since we don't really know what will be available at that point. if we wait till full retirement age, let's say 67, so not early, not delayed, we're supposed to receive nearly $6,500 per month. Our house will be paid off soon. We have a fully paid for vacation home, another rental property, and commercial property, and we intend to keep those either as rentals or sell them off and invest the money. While I know we may spend more than I think in retirement, can I actually rely on that over $6,000 per month projection? I know we'll have some mandatory withdrawals in certain investment accounts, et cetera, but I don't know how much of our nest egg we're actually going to need to tap into if we have, at least $6,000 coming in per month. Appreciate your 2 cents, and I'm sure looking forward to a spiffy new t-shirt. Woohoo!
Thanks, Carrie. Great to hear your voice again. It was fun hanging out with Carrie and Stackers out in Aurora. I'm glad that you asked this question, Carrie, because we don't get to cover this topic enough.
I was going to say it's a hot topic in some spaces. I think for planning purposes, when you're looking at Social Security, first of all, to get $6,000, call it $3,200 a person for Social Security, means that you pretty much had the Social Security maximum all 35 years, pretty much. And they're assuming in those projections that you are going to continue to work until you're 67. There could be some changes to that if you choose to retire, let's say when you're 55 or if you're 61 or something like that. There'll be some slight changes as you incorporate more years on the back end. So Social Security is calculated based on your highest 35 years of earnings, indexed for inflation until you're 60. So if you stop working when you're 55, your highest 35 years might include the paper route when you're 11. If you work until you're 70, the highest 35 years might exclude the first 10 years that you worked fresh out of college, if that makes sense. So to get the maximum, which I think is around $3,200, you have to pretty much max out Social Security your entire life, which means that you've probably saved a bunch of money and you've accumulated a decent amount. So I think it's a perfectly great idea from a retirement plan standpoint to run a plan both ways, to say, well, what happens if Social Security exists at 67? What happens if it exists and I take it at 70? What happens if it exists, but I only get half as much because, a spouse passed away, or they changed the rules, or they tax more of it? There's all sorts of different things that can happen over the next 20 years in terms of tax rates and benefit projections and all that sort of stuff. I personally believe that from our generation on, there's not going to be any material changes because it's too far, it's too late, and we start voting as an age demographic. If you're going to change Social Security, you have to change it for 20-year-olds. First of all, it's more fair because they haven't contributed their whole life. And secondly, they don't vote if you're a congressperson, right? Generally speaking, young people don't represent themselves well at the polls. So you can change it and they'll just be mad and they won't vote you out of office. If you change it for 55-year-olds, they will be mad and to vote you out of office. So if there's going to be changes, I think it's going to happen on the back end. The other thing that probably will happen is they will change those retirement years. So instead of saying, hey, we're going to give you benefits at 60, 62 or 67, now I think they're going to change it to 70. That's just, if you look at the trend of withdrawal, RMDs, they've increased those to 75. Part of that is part life expectancy, but also people are just working longer. So I think there's going to be more of a change in that direction, which shouldn't affect benefits. In fact, just that simple change, I've read a report that says if you change the retirement age from 67 to 70, it solves all the Social Security problems, period. Full stop, done. Fully funded, no problems. So that's going to take some stones to get through Congress, but it'll happen eventually. From a planning standpoint, I think you can count on it. I really do. I think it's prudent to do some projections without it.
I 100% agree, because what I really like in any plan is to hope for the best and plan for the worst. As an example, see how high you can push inflation up and still be okay. See how low you can accept from stock market returns and still be okay. See how little Social Security you need to make your plan run and make it okay. And of those, I think definitely Social Security is a very safe bet. I think the stock market, if you've got 15 years or longer to play with, also a fairly safe bet, just because of the nature of companies and the debt that they carry and shareholder expectations and having to make money for those people or else, or we'll see a new regime running that company. I think in order that's probably 1 and 2, and then inflation, who the hell knows, right? I think the more inflation goes up, frankly, the more then the stock market goes up just to keep pace with it. because you're making goods that are also going up with the rate of inflation. But I kind of like, OG, this idea of having a plan where I know I've got these built-in escape hatches and safety valves where I go, yeah, I expect to get full Social Security, but in my plan, it's only 3/4.
Yeah. I think it's a great idea to establish guardrails and adjust your spend, especially if you've got discretionary spending, excess discretionary spending where you're like, hey, I think I'm going to get $6,000 a month from Social Security. Obviously, it's just going to be taxable. I've got $4 million in my investment account. I don't need another $200K out of that. I'll take 100. But knowing that that upper range is 150 and you can dial it back to 50 based on, market results, or every 3 years you do a big family vacation, and that's going to kind of push that withdrawal rate up, during that period of time. If you got those guardrails, I think that provides some context every year of, as long as my spending's in this range, I'm probably okay. And if all of a sudden the market performs better than expected and my portfolio goes from 4 million to 7 million, well then, hey, the guardrails have moved. Now I can do this, or I can do other things. I can plan for a big charitable gift or a legacy of some kind or whatever. Likewise, if the market moves against you or there's changes to other cash flows, you can move your guardrails the other direction. If you have that excess, which it sounds like they do. So, or potentially will. That provides a little bit of context also, I think, from a planning standpoint, as opposed to just saying you can take 4% out.
Right. Yeah. Thank you so much, Carrie, for the question. If you've got a question, stackingbenjamins.com/voicemail gets you on the list. And as I mentioned, it's usually this time of year where the barrel is a little smaller, the question barrel. It's filling up, but get in early. stackingbenjamins.com/voicemail. If you're here because you're not just worried about withdrawal rates, you're worried about just your overall plan and whether it truly makes sense or not. Maybe you need better people in your corner. Head to stackingbenjamins.com/OG. And that's a link to him and his team's calendar, because they are taking clients and they can help you make better decisions this year. That first meeting talks about exactly what you're looking for and seeing how they would interface with you. stackingbenjamins.com/OG is that link. All right. Time for us to wander out to the back porch, guys. Doug, a lot going on in the basement.
Absolutely, Joe. There's a ton of great stuff coming up. We've got some great Instagram lives coming up this week, but I know one thing we really want to get people excited about is the Valentine's Day giveaway coming up.
Yeah.
Talk more about that. Tell us, how many millions of dollars are we giving away for Valentine's Day?
Well, here's the deal, Doug. First of all, we don't care if people have a Valentine or not. Kind of a Hallmark holiday, right?
Yeah.
I mean,
tell that to the guys in Chicago that didn't quite make it out. Sorry.
Too soon?
Yeah, might be too soon.
I thought the Valentine's Day massacre is what happened when you walk into a Hallmark store and see the markup on those cards.
Great save.
You're getting a box of roses from Costco when they're normally $24. Instead they're $48. What the heck?
Right. Have you seen that Costco? That's a video that's been going around where the guy's got two slips of paper. One is eat at home and one is eat an exclusive members only club. And so she picks the eat at members exclusive club, and it's the hot dog at Costco. not quite what she was thinking about. So we don't care if you have a Valentine or not. What we do want you to know is that you stackers are our Valentine. Isn't that great?
No.
Yes, you're welcome. And we don't want you spending money frivolously on this holiday. So one stacker is going to get to spend our money instead.
I'm just picturing.
Hold up.
So here's the deal. Take whoever you want out to dinner, whether it's your Valentine, a group of friends, whatever. And we are giving one stacker $200 of our money. Now, here's the deal. It has to be at a local restaurant. It can't be at a national chain, because we also want to celebrate some of those hardworking restaurants and cool, quirky places at the town where you live. And we will publicize that restaurant and the fact that you chose them for your super celebration. And you and your friends get to spend $200 of our money. If it goes, it'll probably go way over $200. If it does, the rest is on you. But the first 200 is on us. So how do I get this goodness in me, Doug? How do I get it? Do you know how?
I have no idea, but I'm pretty sure you're going to tell me I'm not eligible, as usual.
Yes. Sadly, you are not eligible. If you sign up for the 201, stackingbenjamins.com/201. We are tracking everybody who signs up between now and February 12th. So if you sign up, you get an entry. If you're like, wait a minute, I already signed up for the 201. 201's awesome. You know, whether you sign up now or sign up later, you get 3 entries every time you use a referral code. Inside of our 201 newsletters, there's a referral code. Use that to sign somebody else up. It's super easy. And when your friend actually signs up for the 201, you'll get 3 and they will get 1 as well. So one person winning
stacks on stacks.
Yes, winning our Valentine's Day giveaway. So 3 to refer somebody, 1 to sign up.
Wow.
stackingbenjamins.com/201 is where you go. And we're tracking all those people through the 12th. I think that's our big thing today, Doug.
I mean, I don't know why I'm going to talk. Why would I even say anything after that?
I know, just drop the mic. We'll just drop the mic there. Why don't I turn it back to you then? Doug, besides that, what's on our to-do list today?
Well, Joe, here's what's stacked up on our to-do list today. First, take some advice from Jack Schwager. Wizards win at investing, not because they have some great insights. They do. And not because they're on top of the market every day, though they probably are, but because they have a plan and stick to it. Want the first step in becoming a wizard? Stop blowing up your plan, looking for new or maybe even a better one. Just stick to the plan. Second, from our headline, budgeting out loud, I don't care what you call it. Tell your friends you're making financial decisions that help you stay in the game longer. That will make you a wizard. But what's the biggest to do? If you're practicing to become a part-time magician, don't bother asking Joe's mom to be your assistant. She wouldn't even let me saw her in half, even after I told her that wasn't blood on my chainsaw. Thanks to Jack Schwager for joining us today. You can find the new expanded edition of Unknown Market Wizards wherever books are sold. We'll also include links in our show notes at stackingbenjamins.com. This show is the property of SB Podcasts, LLC, copyright 2024, and is created by Joe Salsihai. Our producer is Karen Repine. This show is written by Lisa Curry, who's also the host of the Long Story Long podcast, with help from me, Joe, Kate Younkin, Karen Repine, and Doc G from the Earn and Invest podcast. Kevin Bailey helps us take a deeper dive into all the topics covered on each episode in our newsletter called The 201. You'll find the 411 on all things money at The 201. Just visit stackingbenjamins.com/201. Wonder how beautiful we all are? Of course you do, but you'll never know if you don't check out our YouTube version of the show, engineered by Tina Eichenberg. Then you'll see once and for all that I'm the best thing going for this podcast. Once we bottle up all this goodness, we ship it to our engineer, the amazing Steve Stewart. Steve helps the rest of our team sound nearly as good as I do right now. Want to chat with friends about the show later? Mom's friend Gertrude, Stacy Doe, and Julia Garib are our social media coordinators, and Gertrude is the room mother in our Facebook group called The Basement. So say hello when you see us posting online. To join all the basement fun with other stackers, type stackingbenjamins.com/basement. For more interactive fun, join us on Instagram every Tuesday and Thursday for our Instagram Lives. Kate Younkin and Joe host those weekly. Not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.